Great, well, welcome back. And now we're going on to lesson 7, where we're going to think about doing a DCF valuation for this company. And I always like to think about DCF valuation in 5 steps. The first step is to estimate the unlevered free cash flows, which you can see we're going to be doing in rows 16 down to 24, starting with operating profit. So these are the free cash flows that the business would generate irrespective of how it's being financed. So it's kind of ignoring the interest and the debt that's being put on the business at present. The next step, step 2, would be to estimate the weighted average cost of capital. And we haven't really got time to look at that in this course. This is going to be covered in a later course that I'm developing. But we've got an assumption there of 10% that we're going to use. Step 3 is then to think about estimating the terminal value, and we've got 2 different approaches which are quite commonly used, the so-called perpetuity with growth method and the multiple method. So this is estimating what we think the business is worth at the end of its forecast period. So we're assuming we can go out 5 years, have a reasonable visibility of the next 5 years of trading and cash flows, but beyond that we haven't really got much clue. So we're going to have to estimate what we think the business is worth at the end of that 5-year period based on what's going to happen into perpetuity. Step 4 is then discounting everything, discounting the cash flows, discounting the terminal value to come up with a present value, and we're summing the present values of the forecast cash flows and the terminal value to get to a total enterprise value in row 36. And then the final step is to work out what our estimate of the equity value, the value of the shareholders' share in the company is. And if we do have a number of shares, which we do, we've got 80 shares, 80 million shares, we can then estimate a target share price, what we think the price per share is for this business. So let's start off at the top. Forecasting the unlevered free cash flow, and I've got to bring in a lot of the numbers from my other statements which I've already forecasted. So I'm going to start with row 16, operating profit. That's coming in from my income statement. Row 12, I'm going to drag this across actually, if that's okay, because I want to calculate. Well, I'll drag it into year 1, so I can do the calculation on operating profit. So I then want to tax the operating profit. Now, this isn't the same as tax expense that I have in my income statement, because we're just taxing the operating profit rather than the income before tax. So we're ignoring the interest that we had in our income statement here for tax purposes. So my tax rate I had as 30%, and I'm going to apply that to my operating profit here. And then that will get me down to a subtotal, which is commonly referred to as net operating profit after tax, or earnings before interest, but after tax. So I've got an estimate of 74.2 for that number in year 1. Then, just like in my cash flow, I need to add back the depreciation, take off the capex, and look at the cash effects of the other operating items. So the rest of these numbers should just be coming from my cash flow statements, and that's why I'm going to get them all here. So if you go onto the cash flow, I'm going to add back the depreciation, take off the capital expenditure, and then bring in the 3 other operating cash flow numbers. E12, E13, and E14. So that gets me down to my next subtotal, my unlevered free cash flow of 52.6. So this is, I'm saying my business would generate free cash flow from operating activities of 52.6, irrespective of how it's being financed. It could be financed with a mixture of equity or debt, or all equity. And we're not really worried about or thinking about how it's being financed at this stage. So 52.6 is my unlevered free cash flow. Unlevered simply refers to not having any debt cash flows in there. It's just all operating cash flows. And I'm going to copy that across to year 5 to complete the forecast of the unlevered free cash flow. So that's step 1 done. The step 2, I've already put an assumption in for the weighted average cost of capital. So we're going to move on to step 3 and look at these 2 estimates of terminal value. Really the most common approach used, the standard approach, is a perpetuity with growth. And you can see the formula there in my note. So it's taking the final year unlevered free cash flow times 1 plus my assumption for the perpetuity growth rate in those unlevered free cash flows, divided by the weighted average cost of capital minus that growth rate assumption. That's a standard formula, financial math, for a perpetuity with growth. So the final year free cash flow, 64 in cell I24 times 1 plus my growth rate assumption in D10 divided by the weighted average cost of capital minus the growth. So that's giving me a value of 941.9 at the end of year 5 based on that approach. And then as an alternative, it's always good to do a bit of cross-checking, sense-checking for how reasonable that number might be. We're also going to use this other method, which is also commonly used, known as the multiple method. And that usually we take the final year EBITDA in year 5. And EBITDA is a phrase I've not referred to before. It's essentially the operating profit, or the EBIT. Add back the depreciation and any amortization. And there is no amortization in this company, but nevertheless, it's still referred to as EBITDA, even though it doesn't have any A. It's just a generic phrase, EBITDA, referring to EBIT plus any depreciation and amortization that might exist. So in this case, we want to take the EBITDA, which is going to be my operating profit, plus my depreciation. So I16 times I19, sorry, I16 plus I19 times by that multiple that we're assuming the business would be worth of its EBITDA in year 5, sorry, in year 5. So 6 times the EBITDA in year 5 is another estimate of what we think the business might be worth. And that's 6 times multiple. Again, it's an assumption, and there are various approaches used to try to make a sensible assumption here. But again, they're beyond the scope of this course, and it's something that I will cover in a later course with you. So I've got my 2 estimates of terminal value, and you can see I'm going to use both methods to estimate a value in these 2 columns down here in my final step. So here we go. We're going to start discounting now. Step 4 to discount the cash flows and the terminal value. And to do that, I want to calculate discount factors. And these are decimals, which I apply to the free cash flows to express them in terms of the present value of those cash flows to me today. So everybody has a time value of money, a cost of capital, a time value of money, so that cash is always worth more to me today than it is in the future. And if I'm gaining some future cash flow, I want to discount it back at my discount rate to express it in present value, today's money terms. So my discount formulas, or discount factor formulas, are given by the formula 1 divided by 1 plus the discount rate, which I've got in D10, close brackets, and then to the power of the time period, reflecting how far away we are. So that is a standard formula for a discount factor, and we're going to copy that across. So I need to put dollar signs around the D9 cell reference. So if you just go into the formula, in the formula bar up here, you can either press F4, or you can just do Shift 4 to put the dollar signs around the cell reference D9. So that is my year 1 discount factor. To express my year 1 unlevered free cash flow in today's money's terms, I want to apply it to the discount factor. And there we have it. It's worth only 47.8 to me today because I have a 10% cost of capital. So again, I'm going to copy those formulas across. into year 5. And then I'm going to sum them up now to express the sum of the present values of those cash flows. So I'm going to build a sum function equals sum open brackets, and then select those 5 cell references there along that row to get to the sum of present values of those cash flows. Now the terminal value occurs in year 5. So to express the present value of that, I need to apply the year 5 discount factor. And I'm going to do the perpetuity method in column D. So I'm taking the perpetuity method terminal value, I26, and applying the year 5 discount factor to that. And that then gets me to a present value of that of 584.9. And then the sum of those 2 present values gives me the value that I think the company is worth today. And that's also referred to as the enterprise value. So it's the total value of the business. It's not thinking about how the business is being funded. It's just thinking about the value of the business as a whole, based on how profitable it is, how cash generative it is, not thinking about the mix of debt and equity that's being used to fund it. And I can express that value as a multiple of the current EBITDA, or the most recently reported EBITDA. And that's really why I've put values in for D16 and D19, because I want to take the enterprise value I've come up with and see what that is as a multiple of the current EBITDA, which is a proxy for cash operating profits. So saying that's worth equivalent to 5.1 times the current EBITDA that the business is generating. Let's go and have a quick look at the multiple method before we go any further. So for the multiple method, the sum of the present value of forecast cash flows is going to be exactly the same, because it's only just the terminal value that's different. So again, I'm going to build a sum function to sum up those forecast cash flows. I could have just linked it to D34 as an alternative. And then I'm going to calculate the present value of that terminal value using the year 5 discount factor and apply it to that terminal value estimate. So I'm getting a slightly higher value overall. Sum the 2 together. And again, I want to express that as a multiple of the current EBITDA. So divide by the sum of D16 and D19. And that gives you a multiple of 6.2 times. And then I think it's also just to see what proportions of value are represented by the sum of the present value of the forecast cash flows and the present value of the terminal value. So that's why I've done a little bit of shading in column E here. I think it's always worth just looking and seeing just how significant the proportion of the terminal value is to my overall valuation. So this is really what makes discounted cash flow valuations so subjective, because we have very little visibility normally as to what is going to happen with this business beyond the forecast period. But nevertheless, on the basis of our calculations, we can say at least 70% of the value is represented by all the cash flows that the business is going to generate beyond year 5, or based on the valuation of the business at year 5 in the future. Now, having got to enterprise value, we want to go on and look at equity value. So how much are the shares of the company worth for the shareholders? How much is their value? So to do this, conventionally, what we would do is add the cash and take off the debt, effectively adjusting for the net debt that the business has on its balance sheet today. So I'm going to add the cash from my balance sheet, take off the debt that I have on my balance sheet, and that would get me to an estimate of what the equity value is for the company. Total enterprise value plus the sum of cash and take off the debt. And then if I had a number of shares, I can then just divide by the number of shares to get to an estimate of the price per share for the company. And then I can just make the same adjustments for the multiple method. The only thing that's different really is the value attached to the terminal value here. I'm just copying those formulas across. And you can see, as before, I end up with a higher valuation using the multiple method because I've got a higher terminal value. So using those two methods, I could estimate, using this discounted cash flow valuation approach, a valuation of somewhere, or enterprise value first, of somewhere between 796 and 962, and an equity value of somewhere between 661 and 827, and dividing by the number of shares, an estimate of the share price of somewhere between 827 and 1034. So that's a very, very quick look at DCF valuation. There's obviously a lot more we can say, which I'm going to save for another course. But now we're going to move on to our final lesson, which is looking at doing a quick leverage buyout based valuation.